Well, thank you, Erica, and thank you, Mike and Tony, and everyone involved with putting this presentation together. I think it's critical right now to understand where we are in the cycle, and we tend to agree with Mike's comments initially that the level of employment is going to be a key to watch. And that'll be one of the focuses that we have as we go through the first half of the presentation, which is specifically focused on the economic impact. Today I plan to walk through really two main topics: how the virus and our efforts to contain it have really decimated the economy, and then number two, what we expect the impact to be going forward. Then I'll turn it over to Michael to talk about what he sees happening with credit unions specifically. For part of my presentation, I'll walk through what we know about the virus, which really isn't enough, the policy response, detail what we see happening in the real economic data, and then highlight a couple of reasons why we think it's going to be a tough road forward, particularly for the consumer. And then at the end, I'll give our expectations for interest rates and explain why we think that interest rates are going to be low for a prolonged period of time. As it relates to the virus, and I don't want to, this is a bit of a disclaimer, I don't want to get into any conjecture. We're not epidemiologists, we're not virologists. As economists, we're focused on how it will affect economic activity, and specifically how it will affect consumers' ability to go out and consume goods and services, and how it will affect their willingness to go out and consume goods and services. We're also looking at how it will affect businesses' ability to deliver goods and services, and then how policymakers will respond according to those factors. And so as a result of that, we have to take a view on how long the virus will persist, how bad it's proving to be. Is it bad? Our initial question was, is it bad enough to affect consumer decisions? Surely it's proven at this point that it has proven to be bad enough to affect those decisions. And then how it will drive, again, consumer and policy perceptions and decisions. So foundational to our outlook, and there's a great amount of uncertainty about these things, so I want to emphasize that going into this. There's a great amount of uncertainty about this, but foundational to our outlook is that the virus will stick around throughout the year and into at least the first half of 2021. It will continue to create rolling shutdowns in certain areas, and that consumers will not fully return to their normal behavior for a long period of time. One important caveat, which we'll get to later in the presentation, it's particularly important right now, is to differentiate between the consumer's ability and willingness to go about business as normal. So what do we know about the virus? This chart gives you a few of the things a few of our underlying beliefs. This is data that comes from the CDC's pandemic planning toolkit model. The CDC specifically says this data is not supposed to be predictive in nature. It's just supposed to help public health officials in their preparedness and planning. But beneath the model, there are a couple of assumptions that we find interesting. On the left, you can see the virus transmission rate that they estimate somewhere between 2 and 3. The best estimate that they have is 2.5. The implication of that is that without any effort to contain it, each person who's infected would then spread it to 2.5 other people. So then you layer on efforts to contain it, and you try to reduce that number. But overall, 2.5, which is more contagious than many of the viruses we've dealt with, not as contagious as some of the worst ones. Over on the right, you can see the case fatality rate, somewhere between 0.2 and 1.3%. Still trying to determine what that is. Certainly worse than the seasonal flu, but a lot lower than some of the assumptions in the initial data that we had coming out of China. Some of the other assumptions that they have are listed here. Some of those are interesting, but I want to get back to that transmission rate and look at that, because that really is the key right now. And based on the research coming out of Imperial College, which is part of the CDC planning toolkit, they give 3 different intervention levels. If we're willing to go to intervention level 1, 2, or 3. Intervention level 1, as you can see at the top, if we're willing to limit groups to 50 or less, keep vulnerable people at home, some school modifications, that drops the transmission rate to 1.8. That's basically where we've been recently. If we're willing to go to intervention level 2, That keeps groups to 10 or less. And remember, it's key to get the transmission rate to below 1. That's when the virus starts to slow down its growth, and you see it, the numbers start to decline. If we're willing to go to intervention level number 2, that keeps groups to 10 or less, close the schools, restrict travel, close non-essential business. That drops the transmission rate down to 1, according to this Imperial College data. And then if we're willing to go to fully lock down everything, intervention level 3, that drops it down to 0.25 to 0.33. We haven't done this yet. Some people have advocated for it, but I think the economic cost would be significant. I think it'd be very difficult for us to do this. And the reality is, I don't think the national will is there to do that. So as a result, we expect that we're going to bounce somewhere between that intervention level 2 and level 3 and continue to do that as we see the virus popping up in different places. State and local officials will have to make those kind of decisions. But bottom line is we expect to see it continue to weigh on economic activity as a result. I wanted to include this chart because this is specifically for credit unions in Massachusetts. I expect there to be a lot of questions about, well, what the unemployment rate in Massachusetts right now is higher than it is for the U.S. Why is that the case? Things of that nature. And one of the things you can see is Massachusetts had the outbreak occurred sooner than it did for the nation as a whole. Obviously, the Northeast was affected initially. You had a little bit West Coast, but the Northeast is where the bulk of the initial outbreak occurred. And so this chart specifically shows cases per 100,000. And you can see how in Massachusetts, the cases shot higher, deaths also shot higher in April and May. As far as the remainder of the country, it really started to spread more rapidly in June and July. But bottom line, the outbreak occurred sooner in Massachusetts, and it was, and it's similar level to what the U.S. is dealing with now as far as total number of people infected per 100,000. But there were more deaths in Massachusetts per 100,000 than the country has dealt with so far. And the result of that is the people that saw the earlier outbreaks have put into place more stringent containment measures. They're less cavalier, I guess, about returning back to work, returning back to full mobility. And so we see some of those places that dealt with the earlier outbreaks as lagging in some of the economic data because of that fact, because they're a little bit more anxious about going back to full mobility. The policy, I want to turn to the policy response now. It's really been three-pronged. I'm not going to go through all the details of the policy response. It's history at this point, but it was medical, monetary, and fiscal. The medical response was to socially distance, and then it was the majority of states announced stay-at-home measures. Those lasted on average a little bit over a month, and ever since then there have been various levels of restricted mobility. And then obviously that had economic implications. That shuttered economic activity. And so monetary policy came in. There was a monetary policy response. They cut rates to zero. They injected massive amounts of liquidity via the repo markets. They boosted liquidity and funding in nearly every corner of the financial markets via their 9 liquidity facilities. They restarted QE. In the light blue, in the insert chart, in the light blue line, you can see the amount of asset purchases that have been made during COVID-19 versus QE 1, 2, and 3. And it just shows you how this dwarfs the response, the balance sheet response specifically to the financial crisis. Over on the larger chart, over on the right-hand side, you can see the Fed's balance sheet shot up to almost 35% of GDP very quickly. The fiscal policy was the final prong of the policy response. 3 stimulus packages, nearly $3 trillion in stimulus, payments direct to households. They increased unemployment insurance benefits. They really tried to create a bridge, to bridge the consumer over this gap, this period of time where income was going to be affected, for businesses where revenues would be affected, et cetera. And so they're trying to build a bridge that would last, and you can see by design, it was intended to last for several months, and then hopefully the economy is back on its feet, things are resuming, and it can take off from there. You can see in the dark blue line on this chart, the 12-month deficit. It went from $1 trillion in March to $3 trillion in June, so a massive increase in the 12-month budget deficit. Relative to the size of the economy, the budget deficit is now 13.8%, and that's a concern that we have. And I certainly believe that this will be the focus of future presentations. We're not focused on it now. It's on the back burner for now. We won't talk about it anymore past this slide, except to say it's a concern long term. There are bigger risks to the economy in the short term, and so we won't focus on it for now. Going forward, we expect that there will be another stimulus program at some point, even after the $3 trillion already implemented. Democrats have proposed, and the House have proposed, a $3.5 trillion plan. The White House and Republicans proposed what was effectively about a $1 trillion plan. Both call for additional direct payments of $1,200, different amounts for dependents. Both call for extended unemployment insurance benefits. But they differ significantly on the scope and on the overall size of the packages. Right now, they're having trouble coming to some kind of a consensus agreement, but we expect to eventually see some type of a stimulus program and a fourth round of stimulus implemented. But for now, they've been unable to come to some kind of conclusion on that. In lieu of a fourth stimulus package, the president signed 4 executive actions. This was 3 weeks ago, I guess. A $400 weekly unemployment or bonus bump in the federal component of unemployment insurance, $300 coming from federal, and then $100 coming from states, potentially from the CARES Act money. The president instructed Treasury to defer the 6.2% Social Security portion of the payroll tax, the employee side, from September through the end of the year. We're not sure that that's going to have much of an economic impact at this point because it's just being postponed. It's not being erased. And so as the instructions that were released on Friday, as they state, that money would have to be clawed back in 2021. So we do not think that most businesses will implement that because of the clawback provision in the first half of 2021. So it would have to be made permanent, have to be permanent. Permanently erasing that Social Security payroll tax before that would actually have some kind of an economic impact. The president also instructed the federal agencies, Treasury, HUD, Fannie, Freddie, FHA, to take steps to avoid evicting tenants, and then extended a moratorium on federal student loan payments past September 30th through the end of the crisis. So again, we expect some kind of a package. We expect it to be somewhere in the $1 to $1.5 trillion range. At this point, we're a little bit less certain than we were 3 weeks ago that we'll get some kind of a bipartisan deal, but that continues to be part of our overall forecast, is that there will be some type of a package. So now I want to look at the economic data just to show what's happened, some of the factors behind why we expect to see a slow recovery. I'll start with the big picture. The big picture, the economy shrank 32% in the second quarter. As Mike referenced earlier, it would be hard to imagine this if you'd said this a year ago, that the economy is going to shrink 32% in one quarter. It contracted 5% in the first quarter, so officially in recession. The result was largely as expected, but again, it's still shocking nonetheless. This is the largest quarterly contraction for the economy since the Great Depression. In the inset chart here, you can see it was basically every sector. I won't go through the details of this, but basically every private sector saw a dramatic contraction in the second quarter. The labor market, this is front and center for the first wave of economic destruction. And this is why we think employment is so important right now. Because the first response to the pandemic was preventing people from being mobile, it prevented people from being able to work. And so this is unusual. So as far as history goes for an economic cycle, employment is normally the tail. And it's lagged by the larger economic cycle, and employment tends to lag what happens with the broader economic cycle. This time, employment is what's driving the economic cycle. This chart gives us a perspective on the historic nature of the job destruction. The chart compares job loss to other recessions going back to 1948, and you can see just what percentage of the labor market was lost during the COVID-19 pandemic, down almost 15%. You can compare that versus the financial crisis, where about 6% of jobs, of total jobs were lost. On the right-hand side, you can see that this erased 10 years of job growth in just 2 months. We lost 22 million payrolls over a 2-month period. So far, we've regained 9 million of those. The unemployment rate went from a 50-year low in February to an 85-year high by April. It's now back down to 10.2% as of July. It's expected on Friday to drop back down just below 10% to 9.9%. Over on the left-hand side in the MSET chart, you can see that Massachusetts is still elevated at 16.1%, as I referenced earlier. I believe this is because of the fact that Massachusetts dealt with the outbreak earlier, and so they're going to be a little bit more reticent to go back to full mobility as quickly as other regions might be. Again, we believe this is the first wave, that there will be second-order effects that follow, and so because of that, one of the employment metrics that we're tracking very closely is shown here in the middle, and that's the number of people that are unemployed but not temporarily. Initially, everyone believed it was temporary. Now they're determining maybe it isn't temporary. This number is up 1.8 million from February. We expect to see this continue to rise as you see the second order damage occur. The good news was it did not increase in July, but this is something that we're going to continue to watch very closely because we think this will tell us, as people are able to come back to their jobs or people are able to reopen, then the unemployment rate should pull back. But as this number goes up, the unemployed not temporarily, that will tell us how much true economic damage has been caused and how long we expect it'll take to recover from that. Another thing we're watching closely right now is jobless claims, and I just highlight a couple of things here. They are generally improving. If you look at both initial jobless claims, the state-level programs, and the pandemic program, they're generally improving, but they're still very high. Initial jobless claims at 1.6 million. The reason we're watching this so closely right now is because this is weekly data, and so we get it very quickly. We're able to tell how many people are still filing for unemployment, how many people are continuing to file for unemployment, et cetera. But again, it's improving. But prior to the COVID crisis, the largest number of unemployment claims for any 1 week period was 665,000. That was the all-time high. We're still at 1.6 million. So that gives you some context for how weak the labor market is right now. Over on the far right, the same trends. You can see the number of continuing claims are continuing to improve. They continue to decline, but again, still very high. 27 million people for the week ending August the 7th. 27 million people still filing for some form of unemployment. And we're aware of the various concerns about fraud in the unemployment insurance program, and those are legitimate concerns. I would highlight, though, that even when you take that into account, if you were to subtract some number out for fraud, the number of initial claims is still very high, and the number of continuing claims is still very high. So this is where the rubber hits the road. What happens to personal income with the labor market being affected the way that it has? And so far, the results are a little bit surprising. The chart on the left shows income. It's actually up from where it was before the virus. Before the virus, 19.1 trillion. Then in March, it dipped. And then you see it jumps up to 21.1 trillion. It's now back down to just over 20 trillion. And these numbers are annualized. But again, it's still above where it was prior to the virus. And I want to jump to the next slide to illustrate why that's the case, and then I'll come back to that slide. If you look at why income is up, on the left-hand side, you can see employment income. Employment income was down almost 11% from February to April. It has rebounded slightly. We're up about 5%. It's still 5% below where it was prior to the virus. So the pace of improvement is also slowing a little bit. And so this is one of the reasons that we're concerned about what happens once we get past all of these stimulus programs. Over in the middle chart, you can see one of the reasons that income was up so sharply was because of the government transfers. This specifically is the others category. This is where those transfer payments came, those direct payments to individuals. And you can see how much it jumped in April. This is what pushed income up above the pre-virus levels. And that was a one-time event. Now, if there's another stimulus program, then you could have another one-time event like this to boost income again. Over on the right-hand side, you can see government transfers and unemployment insurance, and you can see how it has ramped up. It's currently $1.3 trillion above the pre-virus levels. However, in July, it was down 7%. That's good news, bad news. The good news is more people are moving back into the labor force. The bad news is going forward, that federal bump in unemployment insurance payments has declined. We know it's at least declined, even with the president's executive action to increase it by $400 per week. It's still going to decline. And then going forward, if that were to phase out, then you would see this start to pull back even further. So far, between the direct payments and between the increased unemployment insurance, the stimulus programs have successfully boosted income where consumers haven't had to deal with a decline in income yet, broadly speaking. I'm going to go back to that previous slide, and so you can see in the middle chart now, personal spending, however, has dipped. Personal spending dropped sharply in April. The reason it dropped was because people simply couldn't spend. They couldn't, even though income was still positive, because businesses were closed, because people couldn't leave their homes, because there were stay-at-home orders, et cetera, spending dipped. It is rebounding, but it remains about 5% below where it was prior to the virus, and the pace of improvement, again, is slowing. And that's a theme that you'll see throughout the economic data, is that the pace of improvement, the pace of recovery is starting to slow down, and it's doing so at a level below where we were prior to the virus. So if people income is actually up, spending is down, where's all the money going? Well, over on the right-hand side, you can see it's going into savings right now. The savings rate is currently at 17.8%. And so bottom line is consumers have a lot of powder right now. If everything were to come back to normal next week, if every job were still there, if you could still travel, eat out, et cetera, then I would say that the fiscal stimulus program effectively bridged the gap, and consumers are in a good position on the other side of it. However, the problem is that we don't expect that all of those jobs will be there. We don't expect that people are going to be able to travel like they were, eat out like they were, and consume in the same way that they did prior to the virus. And so that's where our concern is going forward. Now I'm going to jump through this slide one more time, and so there's several reasons why we don't think that things can return to normal as quickly. A foundational concern was noted at the beginning of the presentation. We expect the virus to continue to be a problem. We expect that there will be rolling shutdowns of economic activity. And so that's the foundational concern. But a specific concern that we have is with the consumer. Even if people are able to go back to normal, we don't think that they're willing to. This survey comes from a Gallup poll. The chart on the left shows when people, or the question that's asked is, if there were no government restrictions, how soon would you return to normal day-to-day activities? And you can see after a vaccine is developed is, 22% of the respondents said after a vaccine is developed. After no new cases in your state, 33% responded in that way. After a significant decline in the number of cases, 18% of the population or of the respondents in this Gallup poll. And then right now, it was 27%. And right now is shown in the lighter blue line. You can see that number, it's increased from where it was in April, but it's roughly flat over the last 4 months. The number of people that are saying right now is in that 25 to 32-ish type range, and that's where it's held ever since March. And so the bottom line is this. There are some people that would like to go back to where right now, even with the virus in place. But the vast majority of people are concerned enough about the health implications that they aren't comfortable doing so. And going forward, even as things start to improve, even if the number of cases starts to improve, et cetera, we still expect that there will be some residual amount of people who aren't willing to go back to their activity as normal. And as a result, we expect that overall economic activity will be lower as a result of that. So no matter what, and the response to this has been political, and we know that it's odd, I guess, is the best way to say it, is the response to a virus and the interpretation of it being political is an oddity. But the bottom line is, no matter what I think about it or what you think about it or anyone else, there is a percentage of the population who is concerned enough about it that we expect that will affect economic activity. And that's what I want to show in that chart. Because of that, we're particularly concerned for certain sectors of the economy. Most succinctly, the sectors we're concerned about are non-essential activity, service sector activity, activity that involves a high degree of personal contact, and activity that involves being in foreign confined places. So think of travel, think of going to, even restaurants would be a confined facility, something other than the home. So these are some of the metrics that we're tracking now. You can see this is, we call this alternative data. This is data that we historically have not tracked, but we are now, because it gives us a good indication of how much activity is returning to normal. In the green line, this shows box office receipts. They're still down almost 100%. You can see travel and the number of TSA travelers in the light blue line. Diners, that's actually seen a little bit of an improvement recently. That seated diners remains 50% below where it was on a year-over-year basis. Retail foot traffic down 50% year-over-year. And then the number of employees working, and then the number of small businesses open. And that specifically is an area of concern for us, the number of small businesses that are able to be open right now. That top, and the lines have kind of blurred together in this chart, and I apologize for that, but the top line, the top dark blue line, is the national average for small businesses open, currently down about 20% from where it was in January. And Massachusetts is shown in the blue line below that, just below. It's supposed to be a dashed line, but it's running together on this chart. And you can see in Massachusetts, it's closer to 23% right now. And so Massachusetts, I think because of the reticence to reopen, because of the experience of the outbreak initially, I think that's one of the reasons why you see more small businesses still closed versus the number that were open in January. It's one of the reasons why you see the unemployment rate as high as it is versus the national average. And so, as I mentioned, small businesses, this is one of our concerns. There are two surveys that are, I think, are particularly informative. The one on the left, the Census Bureau survey, the bottom question is the one that I think is most informative, and that is the number of people that expect it'll take more than 6 months to return to the levels prior to the virus, and that is 44% of small business respondents said that. Over on the right, this is the McKinsey survey. People that are delaying some purchases, 72%. Uncertainty preventing me from making investments I would have otherwise made, 85% of respondents cited that. At the bottom, the number of people that expect to file bankruptcy, this is small business respondents again, over the next 6 months, 22%. So a pretty shocking number. Another 17% of respondents somewhat agree with that assessment. So 39% of small businesses believe there is some likelihood that they could file for bankruptcy over the next 6 months. So small businesses, especially those that don't have the ability to access the cash or capital to make it through this period of revenues being damaged, I think that's one of our areas of concern. As I mentioned earlier, this is a very unique cycle, a unique business cycle. You can see this is, on the left-hand side, this chart shows the economic trends during cycles. This is taking the last 4 recessions, and then peak growth, recession, and then recovery and expansion. And at 0 on the x-axis, this is where you hit the peak of cycle growth, and then you start to go into a recession. And we've averaged each of these areas of economic activity. So we've taken the average during each of these 4 recessions. So personal consumption is in the dark blue line. And the thing I would highlight here is personal consumption typically doesn't drop very much. It typically drops just a few tenths of a % and then takes back off. But there is a larger business adjustment, business investment adjustment, which is shown in that private investment, the medium blue line with the square markers. There's a larger adjustment to business investment that occurs, which is what really drives the recession after the initial wave. In fact, there have been some recessions where personal consumption actually hasn't declined. It's just the rate of growth has slowed. But again, you see a big adjustment to business investment as a result of that, and that's what ends up driving the recession. Well, look at what's happening in this cycle. Personal consumption already down more than 8% from the peak, and that was in the second quarter. And these are CBO's projections going forward. But then going forward, it's expected to start to recover, but not be back above where it was prior to the recession until 2022. So again, a small movement in personal consumption historically has resulted in big adjustments to business investment. Today, we're dealing with a massive adjustment or a massive contraction in personal consumption. And as a result, our expectation is that business investment will eventually, once we get through the Main Street lending, the PPP programs, et cetera, eventually that business investment will have to make a big adjustment to what's happened with the consumer, and that will eventually be the thing that drives the cycle. And that's what we call the second order effects of the outbreak. We're also concerned about state budgets. Just very quickly want to highlight this. Over on the right-hand side, you can see that state and local spending accounts for 12% of overall GDP. It's significantly larger than federal spending, which only accounts for 7%. Because they're required to have balanced budgets at the state and local level, we're particularly concerned about the drop in sales tax revenue, which we've already seen play out. This data shows through April year to date, the sales tax revenues of the 42 states for whom we can get data, 37% of those were below their 2019 levels. In fact, more than half of the states saw double-digit declines in sales tax revenues. So we think this is another area of the economy that's going to be under significant pressure. We're also concerned about, and this is our final macro concern, about the fact that we're operating in a very weak global environment now. This comes from the IMF World Economic Outlook. You can see over on the left that their forecast for growth this year is a 5% contraction globally. And then when you look at the advanced economies and you look at 2020 growth and then compare that versus 2021, the thing that you'll notice there is for every advanced economy, the growth rate in 2021 is expected to be lower than the rate of contraction in 2020. Which tells us that based on the IMF projections, every advanced economy, it will take at least through 2021 before they're able to recoup the lost economic activity from this year alone. So a very weak global environment is our expectation, which will make it even more difficult for the U.S. economy to rebound very sharply. So again, a very slow recovery. You can see that in our economic outlook figures. This chart shows our forecast in the blue line. It shows the Bloomberg survey, which is an average of 60 to 70 economists in the gray line. CBO's projections are shown in the gold line. And then the Fed's projection based on their summary of economic projections that they release 4 times a year, that's shown in the orange markers. And you can see that the bottom line is people think it's going to be somewhere between the end of 2021 until well into 2022 before we're able to recover the lost economic activity. We think that by the end of this year, our outlook is that the economy will be somewhere near 6% smaller than it was prior to the virus at year end. So again, it's a lot of excess slack in the economy. And a lot of excess labor slack in the economy. We expect the unemployment rate to be, by the end of this year, to be down to 7.4%. We're pretty aggressive in that. The average Bloomberg survey of economists, you can see, is higher than that, closer to over 9%. But a lot of slack in both the economy and the labor market. And when you're operating with this much slack in the economy, it's very hard to envision a time, any time in the near future, where it's going to make sense for interest rates to rise. The Fed funds rate we expect will be at 0 for the foreseeable future. You can see all of those forecasts here, that all the forecasts after the virus effectively call for rates to be at 0 for the foreseeable future. So the Fed has, just a quick note on the Fed, they've adjusted the way that they approach their monetary policy framework. They just announced the results of that on Thursday, and just very quickly want to highlight what they did. They said that they're doing this because expectations for economic growth over the long term are lower. Interest rates in the new environment are expected to be lower as a result of that, and they believe that the relationship between employment and the inflation rate is now has weakened, so the Phillips curve relationship has weakened. As a result, they're adopting a flexible average inflation targeting approach, which means effectively it means rather than shooting for a 2% inflation target, they now want inflation to average 2% over a period of time. And so that means when inflation is running below 2% for a period, that they are willing to allow it to run above 2% for some period of time, so that in total it averages 2%. What are the implications of that? And they didn't give a lot of specifics about it, which is why they call it a flexible inflation averaging. The implications in the short term, it's very dovish. It justifies more easing, and it raises the bar for future rate hikes. Given that we have persistently undershot inflation, it means that they'd like to get inflation back well above 2%. Well, I say well above. We don't know how far above 2%, but they'd like it to run above 2% for some period of time, so that the average would end up being 2%. So it is certainly dovish in the short term. Longer term, this is good news for depository institutions. It implies a steeper yield curve, particularly during periods of persistent below inflation target. So to summarize, there's a extremely high level of uncertainty with our forecast. We expect the virus will continue to be an issue, and efforts to resume some semblance of normalcy will be challenging. We expect that the consumers will, so far they've been bridged by the government stimulus, but going forward, we expect that they will meaningfully alter their consumption habits, specifically in certain sectors. We're concerned about small businesses. We're concerned about the disruption of state and local tax revenues, and we're concerned about the global operating environment. And again, we expect the Fed to continue to keep rates very low. It's hard to imagine a scenario that warrants them raising rates at this point. I've included here our forecast grid, our economic projections. There's a little bit more detail there you can look through, and be happy to answer questions about that. But for now, I want to go ahead and turn the presentation over to Michael so he can talk about what he sees happening with credit unions now.
And good morning to everyone. I hope everybody is safe and sound and healthy. I'm going to follow up with some information that's really specific to you guys and what's going on in balance sheets across the country on credit union balance sheets, and then talk a little bit about the environment that we find ourselves in, and then give you just a few things to think about in terms of trying our best to kind of navigate this new normal for the time being and to enhance earnings. Just to give you a quick update on what's going on out there, I think, coming into this pandemic and this economic downturn, I do think credit unions were extremely well positioned. I think liquidity was strong, and I think net worth is very strong. In fact, it's about 11.4%, which is the highest level of net worth in a decade. So you've got some good, strong buffers there. What we have seen, which is typical of any economic downturn, is we've seen a strong inflow of deposits. You saw Craig mention the savings rates. We've talked about the fiscal stimulus, and so deposits are flowing into credit unions across the country. On the flip side of your balance sheet, it looks to me like loan demand has been fairly tepid. That makes a lot of sense given the uncertainty. Loan managers are probably reluctant to extend a lot of credit at this point, and then members have the same tendency not to borrow as much when the economy starts to decline. So outside of first mortgages, it really has slowed out there. So the end result that you've seen on your balance sheet is just a rapidly growing cash balance. Deposits are outgrowing loans, and on the investment side, you're getting strong cash flows back probably every month. If you own anything with any type of optionality at all, you're likely getting higher cash flows from those bonds, sort of exacerbating that cash balance. And then in the environment that we find ourselves in, we've seen this yield curve completely collapse this year. And on the front end of the curve, we're basically at near zero. So any excess cash that you're building is pretty punitive to carry because cost of funds is still higher than what you're able to earn on those balances. The other good news, though, is credit quality does remain strong. Right now, we're seeing delinquency rates right below that natural run rate of about 75 basis points. So here's just a quick recap on rates, and to no one's surprise here, we have seen the Treasury curve come down. This is highlighting several key parts of the Treasury curve, and then the effective Fed funds rate. And you can see in the backdrop that is a kind of a gray color. That's where the Fed funds rate is, and near zero at this point. The other thing to think about is just the yield curve, and that is the not only the fact that we've seen yields come down from last year, 120 to 145 basis points across the curve. We don't have a lot of steepness in the curve, and Craig referenced, hopefully that we'll have a little steeper curve to going forward, and that's just so important because, as you guys know, you tend to collect shares, deposits, and you price those on the front end of the curve, and you take that money and you make investments and you lend it out on the longer part of the curve, and so that spread has just gotten compressed. So back in the last financial crisis, we saw the spread between the 2-year part of the curve and the 10-year average over 200 basis points. Right now we're at 57 basis points. So just an extremely challenging operating environment to preserve that interest margin. If we look at some of the balance sheet metrics, and I'm getting all my data, by the way, from CUNA, and I think it's all been updated through May of this year. And so on the screen, you can see the sources of loan growth on the left-hand side. You can see loan growth over the last year, and then loan growth over the first 5 months of this year on your right-hand side of the screen. And probably to no one's surprise here, really strong growth in first mortgages. Every other category this year has declined, though. So, and you can see that first mortgage growth over the last year, a lot of that has come in the first 5 months of this year as interest rates have fallen and your members have either refinanced or done some purchase mortgages. So strong growth there, but otherwise pretty tepid. If we look at on the other side of your balance sheet, liabilities, as I mentioned, deposits are up. In fact, in May, they grew at a 21% seasonally adjusted annualized pace. That is the quickest growth since 1986. So just tons of deposit growth. I think in June, they were up about 16 or almost 17% annualized too. So just incredibly good growth in that second quarter. And if you look at where the money's coming from, it's coming from really inexpensive sources. So share drafts, regular shares are all up tremendously. And then the higher costing deposits, money markets, CDs, IRAs, just up modestly. So at least it's coming in and it's not costing you much. Where's all the money gone? Well, the loan book is shrinking other than first mortgages. A lot of that has just been stored up in cash or investments, and you can see that in surplus funds. So the CUNA group puts this together, and you can see it's a combination of cash and investments. And just since year end last year, you're up 40% in surplus funds. So, and I can't break out how much of that is in cash, but I suspect a large portion of that is sitting in overnight accounts. And then in terms of where the industry is headed from a profitability standpoint, take these projections with a grain of salt, but these are from CUNA, and it shows you the yield on assets, the cost of funds, and then the resulting net interest margin. And so you're going to see clearly we're seeing yields on assets come down. We're seeing cost of funds kind of remain stubbornly high, and CUNA actually forecasts that number to hit a floor of about 50 basis points. I think you certainly can beat that. Many of you already are well under 50 basis points. So I do think you can beat some of these numbers. The margin on the far right-hand side, though, just directionally, if you can see the decline, we're back to levels we hadn't seen in margin since 2015. The last time rates were really low. So 285 level this year, and then down to 250 next year. So lots of pressure on margin. And so I wanted to talk about interest rate risk too before we jump into some recommendations on how to mitigate some of this impact to profitability. We do risk manager services, ALM services, for a number of credit unions throughout the country. And what you're looking at on the screen is just a reflection of their earnings at risk and economic value profiles. This is the current quarter versus last quarter. And what you'll see is there's not a lot of exposure left to falling rates. I think we're here. The exposure is to your current earnings. And then you can see on the other side, to rising rates, and you can see the asset sensitivity has increased for earnings and economic value. And I think a lot of that increase in asset sensitivity just has to do with the extra cash that's sitting on your balance sheet that's built up in the overnight accounts. On the other side, economic value has been enhanced by all those deposits coming in, so that's lifted asset sensitivity. So very asset sensitive by both interest rate risk measures. So how do we defend what's going on out there in this environment? How do we make sure that we can maintain profitability, or at least mitigate some of the downside risk to margins and potential asset quality? If we look at this list, I think the first and foremost bullet point really has to be you've got to figure out a balance to liquidity, and do your very best to deploy that excess liquidity into either securities or loans, and get it out of that overnight account at earning 8 to 10 basis points, as it's so punitive. You are all mostly asset sensitive, so that does give you some capacity to add duration if you can find decent yields. The other thing to think about in your bond portfolio is you're likely to have some gains in some of your positions. So as we navigate through the back half of this year, the second half of this year, and you encounter increased provisioning that's required, think about you do have the ability to harvest some of those gains out of the portfolio to cover that, or at least partially cover it. So that's kind of what I would do, thinking in terms of the asset side of the balance sheet. Liabilities, you've got to aggressively cut your funding cost. There's just hardly any way around this, and hopefully I think members, consumers kind of understand we're near zero interest rates. So I have a bullet point on the screen about just trying to get your funding costs down to 50 basis points before year end, and then component wise, you really want to get your regular shares down to 5 to 10 basis points, maybe 20 basis points on the savings or money market accounts, and then you really need to target CDs. You can borrow money cheaply from the Federal Home Loan Bank. You can issue brokered CDs, and you can get 5-year money probably for 75 basis points. So there's really no reason to pay much more than that 75 basis point range on CDs. And then the other thing you want to do is probably the hardest thing on this page to do, and that's do your very best to mitigate some of the downward collapse in the yield curve by expanding your credit spreads. If you can expand the credit component of your loan rates, you're going to mitigate some of that downward pressure. And another thing I want to just mention before we move on is I talked to a number of credit unions, and a lot of you are just putting money to work as fast as you possibly can to get it out of your overnight accounts. And I do think methodically investing is very good, but there are some of you that think that maybe think that rates are going to go up eventually. So I did want to include a cost of waiting slide. So just a little bit of background about this. If you look at the top of this table, this is what you're earning basically on all the money that you have in your overnight account. That's about 10 basis points, and we expect that to be low for the foreseeable future. If you look at the Fed's projections, they don't have any hikes in for the next couple of years. So we've assumed here for this analysis that rates are going to remain at 10 basis points essentially for about 2 years. And then in the third year, we think, hey, what if the economy has recovered and the Fed can start gradually increasing rates? What if they go up 25 basis points per quarter in that third year? So you're going to average about 73 basis points in that third year. So if you leave $10 million in your overnight account and it's earning those rates of interest, you're going to earn about $92,500 over that time period. On the bottom of the table, I just put in some very simple investment options to think about. And if you can put your money to work in loans, obviously do that first. Because you're going to have better yields. But if you can't, then take excess liquidity and think about some of these alternatives. Even in a 5-year agency bullet, yielding a paltry 42 basis points is going to earn you about $126,000. So that's about $33,000 or $33,500 higher than that overnight account. So just think about that because not investing right now could be more problematic than just leaving your cash in your overnight account. What to do out there in the bond portfolio, and I know a lot of you are managing those portfolios. If not, you're welcome. Please pass these slides on to your portfolio manager because I want to give you guys a sense of what other credit unions are doing out there. What type of bonds are they buying? So we do bond accounting for about 167 different credit unions throughout the country. Their average portfolio size is about 75 million. And on the left-hand side of your screen, you can see what they've been buying. This is the second quarter of this year. This is what their mix of purchases look like. And if you can look at that pie chart, you'll notice that almost half, nearly half, is put into amortizing mortgage-related bonds, mortgage-backed securities, agency CMOs. 19% in agencies. And what was really shocking to me this quarter was credit unions are now buying banknotes. Those are classified as corporates. They're also buying taxable munis. So about 21% of their purchases this last quarter were in credit-related instruments, instruments that have credit exposure. That is well above the traditional 5% that they usually target. So about 4 times as much in credit-related product. And the reason being is because there is a huge supply of taxable munis out there, and the spreads look relatively good versus other products. So on the screen now, I'm showing you just a snapshot of various types of investments, and you're going to see at the top agency bullets. In the middle, you'll see agency callables followed by taxable munis. So you can see right in the middle of that table is a base case yield with rates unchanged. And of course, we're very low here, but if you look at agency callables and taxable munis, you can pick up some relatively attractive yields in those two products. So clearly, I have to say that taxable munis do require a little bit more due diligence. There is a credit component. You have to take your time and understand what you're buying, and there are NCUA limits on what you can hold. I think that's about 75% of net worth, but it is worth thinking about as other credit unions are trying their best to kind of navigate these waters. We're all doing things that we haven't done in the past to make sure that every little thing we can do to mitigate earnings pressures is something out there we ought to consider. Moving on to mortgage-backed securities, I want to just quickly tell you guys, Craig mentioned this, but during QE4, the Fed has been buying up treasuries in addition to agency mortgage-backed securities and some other sectors as well. On the screen, I've got a graph of a 30-year bond, a 30-year mortgage with a 2.5% coupon. And you can see back in January, those bonds were trading about 99, so a little bit under par. And you can see now that they're above a 105 price. So the Fed has come in, they bought almost, I think at the end of this week, they will have purchased $1 trillion. So they own approximately 30% of all agency mortgage-backed securities that are out there. So they're a big buyer. What has that done to the market? It's driven up prices, its spreads have gone down, and yields on what you're buying have gone way down. So if you look at the table on the right-hand side, this is using YieldBook, which is one of my favorite prepayment models out there. And yes, these yields are predicated on various prepayment assumptions, but you can look at this chart and get a sense that 10-year, 15-year, 20-year, 30-year agency mortgage-backed securities, there's a lot of negatives on that page, meaning that you're going to lose, you're projected to lose money on that bond if you purchase it at these prices over the lifetime of those bonds. There are only a few positives. And listen, none of these estimates, these are all estimates, they're not going to be completely right. There's other prepayment models out there like Bloomberg, so you got to look at both. But the point of this slide is to tell you the Fed has driven up prices to nosebleed levels on generic product out there in mortgages. So you got to be extremely careful of what you buy. One thing that we're talking to credit unions about, and they're doing a lot of, is just buying collateral out there that has some prepayment friction, so you're not as exposed as you would be with generic collateral. This is a chart. It's really interesting. I think this is one of the keys to this presentation if you're looking for things to do with excess cash and thinking about buying mortgages. This goes back to January this year all the way through August. These are CPRs. These are prepayment rates on a monthly basis. The darker blue lines that shoot up to almost 41 through August, that's generic collateral with a 3% coupon. So they're prepaying very quickly. And if you own those at a high premium, you're likely getting lower yields or even negative yields. So what can we do to replace that type of purchase? Because it's generally been a very good investment choice for credit unions. You can look at other things that have what we call prepayment protection or prepayment friction. So things like New York paper. New York has a nasty tax that's associated with refinancing, so people are less apt to do it. You can buy investor loans. You can buy pools where the loan balance has a maximum size. So at the very bottom of your screen, you'll see a lot of descriptions. LB 125, LB 150, 200. Those are the loan balance, the maximum loan balances in those pools. So the lower loan balance, they have less refi incentive. So that's what I would be targeting. I would avoid trying to buy any type of generic collateral. I would buy things that have either extremely low coupons, low premiums, or collateral, again, with that prepayment friction. And I've outlined at the very bottom of page 16, you'll see a better description of all those types of collateral. And you can get that in a mortgage-backed security or a CMO. The other opportunity, guys, is if you need gains, that is going to be a very good sector to look at. So if you have the type of collateral that the Fed is buying, you're likely to have some nice sizable gains in those positions. So that is a good source to target if you need gains. The other thing I will tell you, and we'll quickly here, about to wrap up, if you have a hard time generating loan demand in your local market, consider loan participations or buying loans. We have got a matrix on the screen of all the various types, the yields, the average lives, and we do have an active trading loan trading desk at Vining Sparks, as well as other broker dealers across the country. So that could be an opportunity for you looking out there. The other thing to keep in mind is if you build up a concentration in those 1 to 4 family first mortgages, if you're putting on too many of those and you get uncomfortable if that is excessive versus net worth, you can sell loans into this market. So keep that in mind. And then finally, if you think about putting money to work, and I've been sort of preaching, making sure that you don't have too much excess cash. You've got to balance liquidity, but you don't want to sit on too much because it's so punitive. If you overshoot, if you put too much money to work, and 6 months down the road, you have a withdrawals of some shares, deposits start contracting, you have stronger loan growth, you always have the opportunity to borrow in the wholesale market. So brokered CDs, FHLB borrowings, they're extremely cheap. So keep that in the back of your pocket if you need it. That is going to be a good liquidity source down the road if you do see some deposit contractions down the road.